but for tax purposes, it's considered a stock, which means if it's a preferred stock that pays 10% interest, and you got $1 billion worth of it, that $100 million you pay is not considered an expense for the purposes of IRS. But if you actually borrowed money using a bond and paid $100 million in interest, you can write it off of your taxes. It's an expense that's going to reduce your tax bill. You have a common stock. It's typically, there's a nominal value. And you have paid-in capital and stuff. Don't worry about that accumulated other comprehensive loss. For the purpose of this class, I'm not going to get into that. We're just more interested in shareholders' equity. This company doesn't have it, but let's go to the income statements. We've got about less than half an hour. Oh, by the way, these statements are called consolidated. Does anybody know what that means? Why am I not calling it just income statements? I'm calling it consolidated. Again, it's okay if you don't know. This is typically done to minimize gains on tax issues, but more importantly, to protect minority shareholders. I'll give an example. This was actually pretty accepted, not necessarily legally, but society accepted this practice in South Korea. It's called tunneling. Let's say, and in South Korea, just like in Japan, businesses are typically congregated around some sort of major holding companies in Korea or big banks in Japan. In Japan, those are called keiretsus. Before the Second World War, they were called zaibatsu. In fact, zaibatsu was pretty much the reason behind the push for war those days, because they thought war was good for business. And that's actually one of the Ferengi rules of acquisition. Who knows what a Ferengi is? Come on, no Trekkies here? Ferengi is a species in the Star Trek universe. These guys, the only thing they know is profit, okay? And as long as they make profit on it, it's okay. They have 298 such rules. One of them is war is good for business. The next one is peace is good for business. My favorite one is rule of acquisition number 76. I actually use that quite a bit in my life. Every once in a while, I declare peace. It confuses the hell out of your enemies. All right. Let's say as the holding company, and in Korea they're called the chobo, as the top holding company, I'm going to own 51% of the next layer, okay? And 49% is going to be open to public. But I own everything on the top, right? Then the next layer is going to own 51% of the third layer, so on and so forth. That way, at the functional end, directly or indirectly, I'm owning only about maybe 20%, but I have the control of the entire chain. Okay? Suppose at the production end, the company has to buy, this actually happened in Turkey. There was a media company. They, at the very end of the chain, they had a newspaper. And what's the biggest expense for a newspaper? They don't pay much to writers. What do you think? Paper. Okay? So they're supposed to buy paper from someone else. But the family holding company also owns the paper production company, but they own 100% of it. So what they did, this newspaper company, that was owned only directly, indirectly maybe 20% by the family holding. They bought the paper from the newspaper production company at way above market prices. Okay, and they wrote that off as loss. Obviously, the paper production company made money off it. The trouble is, the family holding owns 100% of the paper profit company, but their the interest is only about 20%. So if that extra charge they had, let's say it's $100, they're effectively stealing $80 from the pockets of the small investors, right? That's called tunneling in Korea. You get tunnel from the end of the chain, and from the tunnel you send money to the top of the chain. If you have consolidation, you can't do that anymore. The consolidation means you're going to add the financial statements together. Let's say I'm NVIDIA, for some stupid reason. I decided I'm going to buy a 10%, 50% share in Apple, right? And anytime you have a controlling interest, you have to consolidate the financial statements. So when I'm reporting, I'm going to add my total revenues to the total revenues of Apple, my subsidiary and or investment for which I have controlling interest, and I report that. Whenever you have subsidiaries on which you don't have 100% interest, you're basically over-consolidated. And I don't know why, instead of simply consolidating using the ownership percentage, GAAP says you just consolidate everything. Then you write down an accounting entity that's called minority interest. That basically means I consolidated too much, take that out. NVIDIA doesn't have any of them, but a lot of companies do. And if you looked at Google, the Apple, they do have it. Anytime you have an interest in a company that is not 100%, but you still have a controlling interest. Again, controlling interest does not necessarily mean 51%. You have some ability to affect how management decisions are done. There's a precise definition of that in accounting. If you're too much into it, go look it up. All right? Now, the income statement also has a structure, and everything kind of has a purpose. The way I always look at financial statements, they tell stories, okay? A lot of times, the audience for that story may be different people. I tell a story in balance sheet. I'm telling people what I have, what I owe, but I'm also telling them a story about the short term versus longer term. For example, in chapter 3, we're going to calculate the ratio called current ratio. It's the ratio of current assets to current liabilities. We like that number to be big. If I'm if I'm a creditor to this company with very short stuff, I want to know that they can pay me. Yes.
I was going to say real quick on that is that I understand the whole perspective issue because like in my old job, a lot of our brokers and sellers of services would try to like keep the books as clean as possible, but because of all the international business and the complications that the sheets can provide, even one slight sentence calculation can ruin your entire period. So it is best to always check in with all those perspectives.
Yeah. Because companies have stakeholders. You're not making these just for shareholders. Shareholders, creditors, even society for social responsibility and that kind of stuff. Definitely regulators.
Yeah, they have.
All right. Tax people. And in the income statement, you start with revenues. Okay, these are revenues, a fancy name for sale. But there's a certain way you can recognize something as a sale. It's basically called the recognition principle. it's, I'm not exactly sure on the exact wording, but it basically says, the sale process is essentially complete and there is almost certainty that you're gonna collect. Obviously, if I sell a phone and they pay me cash, process is completed and I don't collect it. If I sell a phone, but I sell it on credit, well, as long as I don't view that credit as doubtful, I have reasonable certainty that I'm going to be collecting. Just because I'm not collecting the money now does not mean that I'm not recognizing that sale. I sold it. When the actual cash comes is irrelevant, as long as you can ascertain that it's okay. That's called the accrual principle. Okay? Sales accrues as soon as the sales process is complete and you're almost certain that you're going to collect. Again, as a kind of a rule, a sale process is not complete until you ship the damn thing. You may have noticed if you order something on Amazon, your card is not actually charged until it ships. Okay? Because until it ships, it's still an asset in the inventory of the seller. Once it ships, they sold it. Obviously, if it doesn't arrive, they're going to have to make an adjustment. And typically, you may see something called net revenue. That's kind of what it is for. Next, you're going to think about cost of goods.